Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. So for some folks, it's not about earning all of their money back, as we discussed in the second part of this three-part roundtable. It's more about not losing any more money from this point going forward. So this segment is going to feature wealth preservation and safe investment strategies from the participants. Editor-at-Large Steve Reitmeister, Kevin Matris, Zacks Maestro of Stock Screens, and our senior market analyst of Zacks.com, Charles Rothblatt. So, Steve, when you talk about wealth preservation, is there a particular point in time that you're taking this from, a chronological point in time?
Yeah, there's people who have different risk profiles, and certainly it's hard to think about wealth preservation without thinking about retirement. And most of us, what we're doing is we're trying to save up that big pot of money for retirement. So looking at the range of surveys, we have people who are in retirement, 5 years from retirement, 15, 20, 30 years away from retirement. And one of the problems in these conversations is we try and give strategies for the average investor. And that's pretty much most of the stuff people will read in the other publications is, here's some ideas for the average investor. Well, that average investor is 45, 50 years old with a family. That may very well fit your profile. It may very well not. So what I want to try and give here is kind of a range of ideas of how you might want to get more conservative, more aggressive with your strategies, depending on how close you are to retirement.
I see.
So one of the rules of thumb that's out there in the financial planning arena is that if you subtract your age from 100, then that's the percentage of money you should have in the stock market. So for example, a 70-year-old person, 100 minus 70 equals they should have only about 30% of their money in the stock market. Why so little? Because at this point they're probably done working and they need access to their money. They can't afford to have the big swings, and so the stock market is just riskier. The outcomes vary quite a bit, and so that person should only be about 30% in the stock market, and probably that portion of the stock market should be more conservative in general. As we work our way out, let's talk about a 50-year-old. A 50-year-old is 10 to 15 years from retirement. Mm-hmm. So using that same math, approximately 50% in stocks, and I would even say going up to 60% in stocks is perfectly fine. Where I think this minus 100 analysis kind of falls off is someone who's like 40 years old or younger. Using that analysis, 100 minus 40 equals 60% of the stock market. I disagree with it. I think that a 40-year-old can be a lot more aggressive than that. That person has 20, 25 years in which to make the money back. History is clearly on the side of that investor having success being the stock market. So I think someone 40 or younger can clearly have 80 to 100% of their money in the stock market and feel very comfortable in this environment. So here again, your strategy should vary according to how close to retirement you are.
No rule of thumb that you know of for money in the mattress, huh?
How high up do you want to sleep, I guess is the question.
So, Kevin, that brings us to you, and that ever-familiar question from people who are trying to practice wealth preservation, right, or who may be thinking about retirement, or maybe whomever, should I sell my stocks now?
I said this earlier, but that really is a question that somebody should have asked themselves 6 months ago, 3 months ago, 2 weeks ago. First off, I have always used a 10% stop loss rule, and I believe that on new positions that would be probably a good way to go. It's helped me to be able to mitigate a lot of my downside exposure during this down move, and I think it's a smart strategy. But some of these stocks have gotten absolutely just obliterated. They're down to ridiculous levels, and a lot of people are wondering, should I get out right now?
Right.
I speak to people on the phone all the time, and some people are telling me that they're going to get out of the market altogether, and they're going to go to cash, they're going to wait on the sidelines, and they're going to get back in once the market gets better. Like somehow they're going to magically figure out when that better market is. Right. First off, you got to ask yourself a question. How much higher does the market have to go in order for you to think that now the market is better or safe for me to get back in? But the real point is, if you have been in during this entire downdraft, and you're just now thinking, I'm going to get out and go to cash and then get back in once the market gets better, you have already proven that you're a terrible market timer. If you're a good market timer, you would have been out at 14,000 in October. So here you are right now. Should I sell? If you have the ability of being able to withstand market risk, I don't think you should be selling out now. Of course, you have to give age and retirement considerations, these types of things. But if you have the ability of continuing to take market risk, what I think you should be doing is you should be looking closely at exchanging the stocks that have the most unfavorable growth projections, that have earnings estimates being lowered considerably. Exchange those companies for the companies that have upward earnings estimate revisions, that have more favorable growth prospects. And make sure you're getting into the industries that should be historically doing the best, not only during economic downturns, but also during economic recovery periods. One other strategy you may want to consider as well, because, we're going to probably see a nice bounce. Hopefully it's going to be fast and furious. But eventually the market isn't going to go straight up to infinity. It's finally going to level out, and you're going to see stocks go up and down. So one thing you could do if you want to stick with some of your stocks is you may even want to consider writing call options against it. A covered write program is a very smart thing to do. And while at times you may find yourself having to give up a portion of your profits if the stock continues to go higher, usually you're going to be able to collect a good deal of premium, and you should be able to generate income by doing this, every couple of months over and over and over again. So if you don't want to get out of your stocks, that's one way to approach it. But again, as far as wealth preservation, I don't think getting out right here is the right thing to do. Exchange the crummiest stocks for the ones with the best projections. I think that is probably the most effective way to be able to attack the market right now.
All right, Charles, safest strategies for wealth preservation.
Well, I think the safest strategy is always cash. And when we say cash, we're not talking about taking your dollar bills and throwing them into a mason jar. We're really talking about, you have two options. One is put into a bank. Make sure you talk to your banker and that the account is actually FDIC insured, not some other byproduct that might give you a little bit higher interest rate but put your money at risk. The new regulations allow accounts up to $250,000 per account to be insured. Secondarily, you can actually buy Treasury bills, short-term Treasury bills from the Treasury, treasurydirect.gov. You won't pay any commissions going through there. On the flip side, say you're someone in decent health, decent wealth, and you want to keep a portion of your portfolio allocated to stocks. One of the options you could have is buying individual stocks from various industries. Look for large cap, trading at low valuations, paying a dividend with rising earnings estimates. The alternative is you keep a portion of your portfolio in cash, and if you're worried in this environment that you may not pick the right stock, maybe you've had a bad run over the past couple months, you could buy an index fund that mimics the S&P 500. This way it gives you exposure to the whole market. You're not worried about having to take a risk on an individual stock over the short term while keeping a big allocation to cash. If you're looking at somewhere in between where maybe you have an existing portfolio, you're pretty happy with what you have, but you don't want to necessarily change it, some of the things you can do, as Kevin said, you can write covered calls on it. The obvious risk of that, if the stock rebounds, you could be forced to sell the stock, possibly taking have to pay capital gains tax on an increase on the stock. Alternatively, you could buy puts, which means if your stock or your portfolio should fall in value, you could then sell it. You guarantee the sell price of the stock. You guarantee the sell price for the stock. Again, you'd be taking a little bit of risk because you do run the risk of actually losing the money you threw into that put if it expires worthless, but it prevents you from having a bigger drop in there. Alternatively, you could also buy an index that shorts the S&P 500. In this case, you'd keep your portfolio of stocks the same, but then you have an index. Should stocks or the major indexes go lower, you'd still have some protection because you'd have that asset increasing in value, which would offset your losses. Those are all options somebody has if they want to maintain their portfolio as it is, but just provide some protection to its current level.
All right, wealth preservation and safe investment strategies amid worldwide efforts to battle this current financial crisis that we're working our way through. Hopefully you found some actionable guidance in this week's three-part roundtable that you can either employ yourself if you are a proactive investor or that you can discuss with your financial advisor if you work with one. With the roundtable crew, I'm Terry Ruffalo.